Hello, everyone. Greg Sykora here, and join with me is Mark Zavitz. Today, we're going to talk economics. We're going to talk Canadian housing, and we're also going to go through what's been going on with gold again and show you some of the recent gold price volatility. So let's get started. So let's kick it off with housing, specifically Ontario housing. The chart you see on the screen is comparing three housing market downturns, bear markets, by showing nominal home prices, and it's tracking performance over time in years from the peak. So in Ontario, which is now the dark blue line, you can see starting in 2022, I've seen on year zero of the x-axis down here, it's fallen sharply for the last 3 years. It's down close to 25%. Now, there's no way to know for sure if we're at the bottom of the market, but I would actually argue that when all of this negative sentiment is baked in and how prices have come down so quickly, it's not to say that we can time the market, but if you're thinking about getting into the market, I would be thinking now or in the near future is not a bad time. Assuming your job is safe and you've got stable income and you can support a mortgage, of course. In the US in 2007, which is the orange line, you could see that prices peaked and then declined gradually for about 5 years. Now they reached slightly lower, but you can see from a steepness standpoint, like we're very similar to the same sort of housing, you can call it collapse, that the US saw in 2007. So Ontario is experiencing something very, very ugly. Then eventually, as you can see, by year 11, they were making new highs after hitting the bottom around year 5, year 6. And then the light blue line, which is Ontario in 1990, which was the manufacturing recession, prices surged rapidly before the peak, similar to now. After the peak, there's a noticeable decline, but it was more of like a slow melt. So from 1990 to about 1996, 97, that's when prices bottomed out. So, if you're someone listening to this video or watching this video and you bought your house in 95, 96, 97, odds are you actually bought right near the bottom. And then eventually starting year 6 into year 7, you can see that there's an upward trend starting again. And that was basically the last time we had any severe housing downturn. And we had about, after that, 30 years of housing bull market. So I made the comment again, why consider buying now? This is purely just a gut feeling. As you know, we cannot predict the future. But when I'm watching the news and when I'm seeing the headlines and everything is directed towards negative housing, how people are walking away, how condo prices are down, how developers are losing money, how realtors are losing their jobs, that to me, from just a headline standpoint, means we're probably getting close to the bottom. And when we're probably getting closer or close-ish to the bottom, that's when you want to buy. Buy low, sell high. It's the same adage for when we want to buy stocks. The same thing can be said for real estate, if indeed you are looking to get into the real estate market.
Yeah, Greg, and it's not just the negative housing media. It's all the negative Canadian economic media. Period.
Yes.
Like tariffs. Just tariffs, unemployment or employment, weak. We've moved from 5 to 7, 7.1, 7.2 unemployment. Just all the negative trade media. So it's a lot of it. Most of it's got to be baked in. Now that doesn't look like interest rates are going to go down much more, but they have come down a lot. And they came down again this week, right? The bank rate came down again this week, another quarter point. And so, that I agree. I think if we're not at the bottom of the housing market in Ontario, we're very close.
I think we're very close for all those reasons. And, it's not to say that we couldn't go down further, but if you consider inflation, as we have in previous presentations, we're down 40%, right? You bake in some inflation in there on a real basis, down 40% is basically a crash, and sure, it might go down to like 3, 4, 5%. We don't know how Trump is going to continue to affect the Canadian economy because almost on a whim, he can, change his mind and implement tariffs or go back on the Kuzma agreement and just change the whole ball game. And it greatly affects the manufacturing sector in Canada as well as anything that exports, right? So anyway, this slide I found very interesting. I found this online about a week ago, and it was just talking about Canadian trade activities and how they continue to be weighed down by Canadian tariffs. It went as far as end of August, and it's showing the deteriorating trade balance. So, I mean, that was the big reason for why Trump was implementing these tariffs in the US to fix the quote unquote trade balance. And that is, very muddy water because it's very convoluted to determine if or not you're being screwed as a country. But just from looking at this slide here, you can see that since Trump's taken power, exports, which was end of January, exports to the US, they kind of improved a little bit near the end of summer, but overall the trend is downwards. And, sadly, I know that Carney and other premiers are getting out there to promote Canada to the rest of the world. We're talking more to Japan, we're talking more to China again, but this is not good for employment. So if this is the next shoe that's going to drop, for right now we have between 7 to 8% unemployment across Canada. Some areas are as high as like 10%, 11%, like Windsor, for example, or Hamilton's around close to 10%. It's like 9.8. We could see a slight more of a correction in housing just because unemployment's going to go up, and when unemployment goes up, people can't afford their mortgages, they can't afford their homes, and then that puts downward pressure on housing. But it's unfortunate, but I think the reality is when we come out of this, we will be stronger. This could be the bottom. We've got low interest rates. We've got all these things that are happening. They just take time to work their way through the economy. So maybe there's going to be a few more months, I think, of negative import-export data, as we're seeing here, where it looks like we're not exporting as much. But I think eventually at some point the tide's going to turn and either things are going to improve with the US or we're going to start to see what we export to the rest of the world increase. I hope at least.
Yeah, and Greg, that chart also interesting. It really shows the softness. We've got 5-6% decrease in imports, 10 to 12 or 13% drop.
Yeah.
While in combined exports, just economic weakness.
Yeah, and if you think about the way a company runs at the margins, it usually needs full utility and to be working on all cylinders at the same time for it to be profitable, right? So if it's only exporting at say 80% or 70% of what it was previously, then it's probably not a profitable company anymore. It's not like things go to zero. It's just that if they decrease by a quarter, then that's going to eventually lead to a whole bunch of layoffs, and there's nothing much you can do. So we just talked about new tariffs. If anyone has missed this, I'm sure most people have seen it by now. But if anyone's missed it, Premier Ford in Ontario launched an ad in the U.S. using a Ronald Reagan speech from 1987 to take a jab at Trump. And this is a speech that was given, I think it was something called Radio, but basically on tariffs in the free market. And it's almost a precursor for NAFTA. But the gist of it is that tariffs in the long run are bad for economies, even if they boost domestic production and domestic economies in the short term. And apparently, since Trump went on air talking about this video, how it was false, mischaracterizes what the speech was about and fraudulent and fake news and whatever else, it's estimated that this video that the Ontario government put out. I think they spent like $60 million on this campaign. It's gotten over 1 billion views. And we all know what followed after that. Trump reacted like a baby, and he cut off all trade talks and trade discussions with Canada. And now he's increasing tariffs an additional 10% on all non-CUSMA related goods. And to go back to our conversation from last week, Mark and I, we talked last week about gold prices, and I found this interesting chart because it shows how a weaker US dollar, as seen by the green line, has aided gold's breakout over the last, year and a half ish, in conjunction with the fact that it's now also now being driven by broader safe haven demand by central banks. So if you're trying to understand why gold prices have gone up, central bankers or people who are looking for safety who would just hold US dollars have been selling a lot of their US dollars. And what have they been doing with it? They've been buying gold, storing gold, buying gold. That is not the first time this has happened. This tends to happen in cycles. And typically when it does happen, it's as a result of geopolitical uncertainty. And we all know what Trump is doing. He's causing a lot of geopolitical uncertainty. And again, last month, as we talked about how gold fits in your portfolio, in the last 2 weeks, of course, as we reached the highs of gold prices so far, I've had over a dozen clients reach out asking about owning more gold. Should they buy gold themselves, buy bullion? I'm guessing they're getting the ads online. The good news is you own gold, or the majority of our clients own gold, and you own it in a few different ways. First, you own it outright as a bullion position in your portfolio through a position called Vault. Okay, Vault is gold. Secondly, you own it through your Canadian stock exposure, predominantly the companies you own that are on the TSX. There's companies like gold producers like Barrick Gold, for example, which is basically just a levered gold play. Mark, you've got your finger on the pulse when it comes to gold because you've been talking to clients about owning gold in their portfolio for 30 plus years now. Anything you want to add about the recent volatility we've seen?
Well, Greg, gold was getting very stretched. Everybody was in. Maybe not 100% of the money was in gold, but the movement over the last 18 months in gold has been fantastic. And when an asset gets stretched, goes up as quickly as gold does, it could be a company share, it could be a commodity like gold, it could be anything, it could be real estate. When things go up that fast, they get very volatile at the top. Just like a tech company that triples, in a year, like one of the AI companies. They get very stretched and they get very volatile. So it's not surprising that we've had a pullback in bullion based on, the last 18 months, a significant pullback. Like you said, the U.S. dollar firmed a bit in the last couple of weeks. The trade tensions between China and the United States appeared to ease somewhat, and that's probably triggered some profit taking.
Yep. Yeah, exactly. And ironically, again, the conversations I've been having about gold all happen near the top. Right?
Well,
all happened in the last 2 weeks.
Yeah, Greg, it reminds me of the Nortel days or the RIM days, and it's very similar. When Nortel peaked at $124 a share, that's when I was getting calls every day from conservative elderly clients saying, can you buy this for me? Just like with bullion.
It never, the cycle continues, right? And yep. I blame, a lot of that has to do with the fact that retail investors, we're bad. We're not good investors. We always buy at the top. and we sell
Yep.
at the bottom. That is the way
FOMO.
retail investors typically work. And now that we get most of our information online, I know for a fact that, at least for those who shared with me, most of the people who were considering adding gold or wanted to buy gold or wanted to know more about the gold allocation that they had in their portfolio, if they should have more of it, they were getting hit with ads online based off whatever news sources they were looking at, uh, telling them about gold's price and how likely gold was going to hit 6,000 or 7,000. Nobody knows, right? Nobody knows. And if anything, this is the time where we don't know, but this is the time where, if we're thinking about it from a portfolio construction standpoint, you actually want to rebalance your gold position, which means trim some of the profit, some of the 50% return you've seen over the last year or so, and just reallocate it to the rest of your portfolio. Simple as that.
Agreed.
Okay, thanks everyone for tuning in. That's our update. We look forward to giving you our next update at the end of November. Happy Halloween.
Hey, Greg.
Still going.
Oh, cut me off then.